In this video, we'll be talking about alternative assets. Undoubtedly, stocks, bonds, and cash, or traditional investments, deserve a place in most investors' portfolios. However, as the returns from these traditional markets surge and yields remain incredibly low, investors are drawn toward other investment opportunities. One particular category continues to quickly grow and evolve: alternative assets. Once reserved only for the ultra wealthy, there are now numerous opportunities for the everyday investor to get exposure to this exciting asset class. What they are, why they are important, we'll go over this in today's video. Alternative assets, do they make sense for me? Quick disclaimer, you can read it on our website. Okay, what are alternative assets? So you have traditional assets, and then you have alternative assets. So traditional assets are stocks, bonds, cash. These are very common traditional assets that deserve a place in many investors' portfolios. However, then you have everything else. So anything that's considered an investment or an investable asset that doesn't fall into that traditional bucket falls into the alternative asset bucket. So we'll go into why these are interesting, but what are some examples? So you have private equity. So this is like a share in a stock market. These are public equities. So this is just privately traded. It's not on a public stock market, but it still represents a share of ownership in that company. Then you have things like real estate, which have a number of different subcategories. You have digital assets or cryptocurrencies, something like Bitcoin. You have what are called managed futures. You have precious metals, so gold, silver, and things like that. And then you have collectibles, so antiques, rare stamps, coins, cards, etc. So anything that's not categorized as a traditional asset then would be categorized as an alternative asset. Why are these things so important? So as the traditional assets and traditional markets are surging, it's the longest bull market in history, over 10 years. Yields are much lower than they have been historically. Investors are starting to look outside into these alternative asset space for higher yield, higher returns, less correlation with those traditional stock markets. So the big appeal of these alternative assets are that they are much lower correlation. They do exhibit much lower correlation with traditional assets. So what this means is if the stock market goes up by 10%, lower correlation means that maybe these alternative assets won't go up by as much, but it works in reverse as well. So if stock market goes down by 50%, maybe these things only go down by a few percent, maybe they go up, maybe they're negatively correlated. So having assets in these different buckets, so traditional, alternative, they tend to move a little bit differently, so they're all not moving together, which lowers your overall risk of your portfolio and allows you to hit those target returns that you're looking for over the long period of time. So they have a number of advantages. So counterweight to conventional assets, what we talked about. It's a good portfolio diversification for your entire portfolio of assets. So you're invested in stocks and some bonds and some fixed income like bonds or cash, while having a little bit of your net worth tied up in alternative assets might change the whole narrative when the stock market corrects or bond market corrects. So some of these, depending on the way that they are structured, could be a good source of hedge against inflation. And because of the nature of them, they're a little bit more high risk, less liquidity, maybe longer term. They could have potentially higher returns than traditional assets. With every advantage, there's also disadvantages. So within alternative assets, again, there's a whole number of different kinds, but primarily they share a number of similar disadvantages, such as they're difficult to value. So this comes up with required minimum distributions later in life. If you have these structured in your IRA, you'll be valuing these, maybe they're liquid, but then you'll have to take a distribution based on that amount. So it gets a little hairy. A lot of them are relatively illiquid. So this means if you want to exit them, want to convert them to cash, you will not be able to as easily liquidate them. So there's a number of things within technology is changing this, adding liquidity to these previously illiquid markets, but currently they still have less liquidity than buying or selling a share of Apple. A lot of them are unregulated, so they're more fringe investments. They're not as highly regulated as a public stock on a public stock exchange. So there is a completely different risk spectrum with a lot of these. And with that, they would be considered high risk by a lot of counts. So low liquidity, less regulation, hard to value. You have to be a little bit more sophisticated to understand some of the underlying assets. So these are characteristics that make it a little bit more higher risk. So what is the key takeaway? Alternative assets. This is a huge category, but the key is that a traditional portfolio comprised of stocks and bonds, so the old one is 60-40, doesn't cut it anymore. These things are starting to get more and more correlated, moving together, and there are more and more alternatives to what your traditional brokerage is offering you as investment. So obviously do your own research, DYOR, but it might make sense to start adding a little bit of these alternative assets into your overall portfolio, protect you a little bit more whenever the stock market does turn.
If you like what you see, don't forget to like the video and subscribe to our channel. We'll have plenty more helpful information coming for the forward-thinking, non-accredited investor like